Good morning and hello, Propenomix people, and hello to Property and Propenomist people as well. Welcome to another video, and this week's I called The Only Way is Up. And of course there I'm talking about house prices. So I always start with a quote, and the quote I used this week as I flip between the great philosophers of the world and the music world is The Only Way is Up. That was from Yaz and the Plastic Population that I remember from 1988, but actually originally written by George Jackson and Johnny Henderson, first performed in 1980, actually, as it goes. So again, I'm projecting forward to the deep dive. We've been talking about tax on property in the past 7 days in the headlines. And so I had to get into the arguments and the analysis of all of that as well. But before I get cracking full hammer, Rod Turner and myself are running our next property business workshop on Wednesday, the 1st of October in London. The subject matter this time around is investment, with an emphasis on what metrics you really need to be considering to run your property business properly and building your business to scale. We're digging into the real fundamentals of property investment for growth, from proper valuation and strategic debt structuring to the investment metrics that serious pros use. Hint, ditch ROI and yield. Learn why some deals work for some and not others, how to manage risk as your portfolio scales, and when to shift gear from side hustle to scalable business. We're going to break bottlenecks, build strategic pillars, and unpack real-life case studies of fast company growth. How have we done so many deals? Well, we'll tell you. Book your super early bird tickets with 20% plus off the face value now at bit.ly/PBWEIGHT. And there's also a link to that in the show notes. But let's plow on with our opening segment then, which is Trumpwatch. So has it also been silly season in the USA? Because we're kind of in full silly season mode now in the UK. Well, there was an FBI raid on a former Trump aide's home. That was John Bolton. There's limited room for critique of politically motivated lawfare on one side of the fence or the other in today's world, it seems. I used a bit of downtime in the past week to watch Lucy Connolly get interviewed by The Telegraph. That was the lady who went to jail for a tweet, if you don't recognise her name. And it's very clear that our government are keen to use the system when it suits. They're just less obvious about it, perhaps, than the United States. Still, upset Donald Trump and bear the consequences, it seems, which I'm pretty sure everybody knew anyway. There was also a flash of the sort of deal that anyone who's remotely neutral, which is rare and difficult to find, expects from Donald Trump, probably why he was elected, right? After a whole variety of funds and pledges issued by the US government, they've swapped these for equity in Intel, a great move in a distressed but giant company. Of $11.1 billion worth of equity at a discount of about 17.5% on the Friday closing price. So that's an immediate paper gain for the government of 1.9 billion. And apparently all Intel needs is a decent CEO after a bad run. Now that feels a little bit simplistic, and I'm sure there's more to it than that. But on the face of it, what a move for both parties. I can't think of a precedent in terms of a move that would help the accounting of a massive company and also show a net gain to the government, and not in a time of crisis at all. So credit where credit is due for that one. What are the fears with a deal like that? Well, those looking to keep Mr. Trump sweet will therefore buy inferior Intel chips over other chips under pressure or otherwise. It feels very geopolitically strategic to me, though, given the various tariff threats around semiconductors as well. And although you fear any plans might be quite simplistic, it does appear to overall potentially be a move in the right direction. The US government's got no voting rights, no board seat. They're not going to be activists here. And it has happened before. The US government put $50 billion into General Motors after the 2008 crash, and an eventual booked loss of $10 billion. Well, of course, that's on the equity side, but had GM collapsed and all those jobs gone missing, how much would it cost them to bring all that back together? How much did they take in tax revenue after that, etc., etc., etc.? It's broader than just looking at the top level financials, of course it is. But this investment looks wiser, and you'd expect Intel to climb on the back of it if they've got the government behind them. The fear will be if the president turns on the company or the CEO, if there's bits and bobs he doesn't like, and then that would affect the share price. But in the next few months, you'd think the price would be going up, not down, if the wind stays behind them. You might also remember the fanfare when the president was told to pay $465 million in civil fraud fines in a New York court some time back, a year or so ago. That was thrown out on appeal this week and will go down as a good result for the Donald. In the same breath, reports of up to 300,000 federal jobs being cut by the end of September under the Doge Cuts initiative were coming in. Tariffs had a quieter week, but the focus was furniture. 50 days has been allocated for an investigation to come up with a number, basically. Overseas manufacturers saw share prices drop. Domestic manufacturers saw stocks rise to a net loss in value overall for shareholders, which of course just reflects the fact that the government will be taking a larger slice of that pie, of course. But zooming out, the tariff chat continues as we enter the 8th month of the administration relatively soon. This market for imported furniture is worth about 25 billion to the US annually. So there's a 10-figure sum to be lifted out here by the government, you would imagine. But anyway, back to our core subject, the real-time UK property market. Chris Watkin delivers once again, week 32 being reported on. Listings printed 32,200, which edged slightly down again as the school holidays continue around the country as far as the figures go. And we're now only 3.5% higher than 2024 in terms of listings, and 7% higher than the pre-pandemic market in terms of listings year to date. But my 10% more stock than a normal market is still holding up based on the fact we've had about 2 years now of overperformance in listings compared to the historical averages. We're 11.6% ahead of the 9-year average, but that does include 2020, which pollutes the figures somewhat. We're really coming back towards the 2024 numbers now, week by week, having been about 6 to 7% ahead of them at various points in the year. But we're still listing more than we're selling. So it's all eyes on the withdrawal rate as a general rule, which is pretty high at the moment. And only 20,600 price reductions in week 32. That's 14.1% of stuff reduced in July's official number, 14% in June. Last year it was 12.1, May it was 13.4, but the 5-year average is only 10.6. But of course, during that 5-year period, we had some time of the market being closed. We also had a fair bit of time of that 5-year period of the market being particularly hot, so not much need for reductions. So we've probably got 25% more reduced properties than a normal market. That's working as a ready reckoner. 1 in 7 being reduced each month. So we're perhaps running at 90 to 95,000 reductions every month, to be clear. So if you think you can't find a deal, I think just keep up the legwork and you'll get there in the end. You don't tend to see 14+% of stock being reduced in strong markets by any stretch when you look back historically. So holidays always slow things a little, but the sideways pricing continues. And then 25,000 homes sold subject to contract, a quieter week, but the yearly average is 26,500, so not incredibly quieter, still healthy, realistically. Sold subject to contracts are up 6.9 year on year and are 14.2% ahead of 2017 to 19, and we're still nearly keeping pace with 2022, which still to this point in the year was a very hot market indeed. With those sold subject to contracts up 6.9, whereas listings only at 3.5 on last year, this signifies more transactions than 12 months ago to this point in the year for sure. Or to put a different way, it looks a bit more like a functional year in the market than 2024 was, even in spite of the stamp cliff that we experienced at the end of March this year. So we went into August with 763,178 homes on the market, up about 5,000 on the number at the beginning of July. Now, for a bit of context, before the pandemic, when the market got a bit stickier, we were at about 660,000, if you remember 2019 being fairly slow. A seller's market is more likely to be under 600,000 on the market. At the end of July last year, 716,000 were on the market. So these are more high numbers that we're seeing. And so this flat feeling I've been talking about in pricing will likely continue to manifest itself. A steady market, not too much excitement as we plough through the school holidays. And it's the second month in a row it hasn't really kicked forward. So it's not really even going up by 1% a month at the moment, which feels like we're at or near a peak. Although I'm just going to hesitate on calling the peak a little bit because we can't trust August numbers too much. There's always a surge in listings in September when the school holidays are over. But there's also a clear out of no-hoper stock where either the agents have had it on for so long or the vendors won't take the medicine the agent is prescribing. Because remember, a great man once told me, there's only one thing wrong with a property that's not selling, and that's the price, realistically. So we need to see these figures before we draw conclusions. Let's see what the first couple of weeks of September do. We're not going to know too much until about 4 weeks' time, I'd imagine. They could be somewhat different this year with so much stock out there. We just don't know. So Chris also looks at the sold price per square foot on sold subject to contracts because it has such a strong correlation with what hits the land reg in about 5 months' time. This month round, well, July hit £344.78 a foot. couple of percent higher than July 24 and nearly 4% higher than July 22. But down about 0.5% on June's number, which was £346.45. So we're looking at this in the region of a 2 to 2.5% up market for 2025. Unless something incredible changes, it'll be a little bit under my prediction, which was 3.75, and it'll also be below inflation, wage rises, and the likes, which was a lot of what informed my prediction in the first place. I'm not going to lie. My predictions on inflation and things which have been more accurate. But the risk of being a broken record, this is very much sideways, sideways, sideways in this market. Fall throughs nudged back further below the long-term average of 24.2, printed 23.2%, relatively normal noise, very little volatility around the long-term average for weeks now. The net sales are still there or thereabouts, 19,300, 5.7 up on last year, 10.6% higher than 2017 to 19. We're not quite at the 2022 levels for net sales, but let's see where we get to by the end of the year. I think it's going to be a close thing on transaction volume compared to 2022, with, one would hope, a much less volatile end to the year. Now, I always give Chris a weekly shout out here because he's more prolific than just this epic tome he releases weekly on the UK property market. Great stats on a regular basis. I get several messages from him a week. He loves this stuff. He's doing what he loves, and that's the best thing in the world, realistically. But please drop him a like, a subscribe, all the rest of it, and some kind words for his content creation. And if you're in the industry and want to support your business, or you want to help grow your business, be a better communicator, be more in touch with your local market, well, that's what Chris does. So give him a shout. His article gets published on the Property Industry Eye website and the video on his YouTube channel at Christopher Watkin. And while I'm on that subject, if you're watching on YouTube, I'd love it if you would subscribe to the channel. It helps out an awful lot. If you haven't already, leave a comment, leave a like, things like that. If you're watching via Facebook or another platform, then please go to the YouTube, Propenomix with Adam Lawrence, and give me a follow, a like, a subscribe, a comment, and all the rest of it. I do read all the comments, and I do try to get back to everyone. Can't always be straight away, but I always try to get back to people. And I really enjoy some of the debates that I have online when I get told you shouldn't buy property for profit, for example. Always some good chat in there, as long as it's kept civil, of course, which it always is from my end. Anyway, time to look through that macro fog once more. Another meaningful week, because first up, my mastermind specialist subject, Magnus, or John, depending on your age, inflation. Fairly ugly stuff. Then the flash PMIs, of course, which I love, as everybody who listens regularly knows. Regular information on the economy, real-time information with some really good news in them, which is great. And then the third slot will look at the OBR's monthly public sector finances commentary. It's quite hard not to do our own commentary on this, of course, side by side with the ONS private rents and house prices report, which is a bit sneaky, maybe. I know, getting an extra one in there. But at the tail end, yeah, gilts and swaps. But you know that would have to be the case, right? Inflation. Feb 21. The Bank of England was talking to the commercial banks about negative interest rates, but I sounded the klaxon. I threw a dart. I said inflation was rising and it'd be 4 years before this was all sorted. Now, you could argue it was sorted, and this is certainly the Conservative Party line at the moment, when we had that fluke print of 1.7% in September 2024. They're not calling it a fluke, of course, but if you look at the maths behind it all, it's very clear why it happened. The energy prices dropping right back down, having a deflationary effect on the rest of the number. This is why I look at core inflation. But anyway, it was 1.7 in September 24, and it was 3.8 for July 2025. So it's a huge print, really. Caught the economists out a little bit. They forecasted 3.7. We're nearly at double the target again. 2 times 2 is 4 ultimately. And there's very, very few people who don't think we're going to be seeing 4-point-something% very soon. It was May 21 when core CPI crossed the 2% threshold from the downside. So remember, core strips out food prices, energy prices, alcohol and tobacco, volatile things, realistically, to give you a more clear picture of what underlying inflation is like in the economy. And core hasn't printed under 3% since September 2021. So that's about that 4-year point. Not that I'm suggesting it will necessarily get under 3% in September 2025, but it was a rough guide, right? So it's one of the main reasons that's kept me talking about this all along. When core has not been below 3, you're not going to be living in a 2% inflation world. Well, what about CPIH? The ONS prefers this measure, factors in housing costs. And one of the reasons why the ONS like this is much more comparable to US inflation because they include housing costs in their CPI. Although in the US, they don't necessarily have CPI as their preferred metric. They have other measurements of inflation that they prefer to use and talk about and influence the markets, the bond markets more. But there we go. But the two often get international comparison without the housing chucked into the UK prices, which is a bit silly. And CPIH is slightly less noisy than CPI as well, because housing costs don't tend to surge forward at 20% like food inflation did, for example, a couple of years ago. But it isn't the time for us to switch to targeting CPIH because that printed 4.2% for July 2025. Now, core CPIH also printed 4.2. Core CPI, 3.8, the same as CPI. So very much a good proxy for the underlying. Now, there's usually a scapegoat somewhere for when inflation beats target. This month it was airfares. Pretty classic summer reasoning, but these prints are high, and I asked my LinkedIn audience to speculate on the inflation high watermark of this cycle. The most popular answer was 4.5 or above, although I think that's pretty bearish. It might get tested. I'm at more like 4.25 for my high watermark, but it will depend on any external factors. And as I've been saying for many, many times over recent years, we're so much more fragile when the underlying is at 3%, let alone 4%, than we are when the underlying environment is more normal. For a great example, recent history, before the Brexit referendum vote, we had a shock as far as the markets were concerned, but the underlying normal conditions meant we absorbed it relatively easily. As far as inflation was concerned anyway. Now, another point of order, food inflation is running at a level which hurts the bottom 10 to 20% much more than anyone else. And remember, food is stripped out of core, right? So whilst it's far from ideal, it obviously isn't the driver here if core is 3.8 and CPI is also 3.8. It's just getting caught up like lots of industries with lots of workers who are paid close to the minimum wage, with the national insurance hikes and the allowances being cut. But one piece of good news, which is lost in the ether, OOH, the owner-occupier measure of housing, absolutely cratered. Now, this isn't a surprise given reports about stalling rents that have been discussed and analysed here over recent weeks and months. But a drop from 6.4 to 5.5 in 1 month is faster than anyone expected. Great news, still too high, but that cycle and the peaks at 8% as recently as the turn of this year are definitely on the way back down to somewhere near normal. Although I still maintain that normal these days is 3%, and I'll be maintaining that throughout this decade. It seems, with the current fiscal policy being the way that it is, I don't see anything different necessarily, deflationary or even disinflationary, coming in the October budget. Owner-occupier housing costs had the biggest deflationary impact on the CPIH numbers this month, equivalent to the amount of that impact that transport had on the upside as it goes, which obviously includes the airfares that I was talking about. Now, I had a look at the airfares because I'm always skeptical about the regular scapegoats being wheeled out. But between June and July 2024, airfares rose 13.3% in a month. Typical school holidays, right? You might think it's more than that, but actually 13.3. Well, that was nothing compared to this year, where they rose 30.2% in the month. So really gouging at the highest level. Food inflation in isolation, basically 5% now, racing upwards. The print was 4.9 up from 4.5. Plenty have speculated this will hit 6% by the end of the year, which is really not good for those in lower income deciles. Well, really, it isn't good for anyone. But underneath it all, goods are also inflating in price at 2.7% per year. Well, that might not sound too bad, but they were deflating in price when inflation was coming back down in 2024. So it wasn't just the energy prices, the price of the goods, which went up during the pandemic because people couldn't buy services and they were only buying goods. They were still coming down and down and down in 2024 compared to 2023. But that's not happening anymore. They're inflating at 2.7. So apart from rental inflation losing a bit of steam, very little has contributed to inflation not going up, if that makes sense. And it does seem very UK focused. France printed 0.9, Germany printed 1.8. So it doesn't look for government numbers come September when they have to face the triple lock for another 4-point-something% increase on pensions, whether that's wages or inflation, because it's pretty close at the moment, actually, but we've got 2 months worth of numbers to come, and the rest of the welfare system. The black hole grows, and be warned, once you have inflation, squeezing it out is very hard, especially while we're busy cutting rates, and have been for 12 months, of course. Now, I said when I analysed pandemics across the years, which had to go back hundreds and hundreds of years to get that sort of data, but they did hold data on things like GDP numbers and stuff like that, and inflation as it goes. And inflation had about a 1% premium on it for about 30 to 40 years historically as a rule. Now, you might think, oh, it'll be quicker these days and all the rest of it, but you can see where my 3% is the new 2% mantra comes from, apart from anything else. But you could argue, look, the economy needs some heat in it, right? I don't disagree with that, but remember, my upside risks, the boring side of things, especially an exogenous shock, remains significant. And that doesn't help any of us sleep any better at night. It's all about risk management, ultimately. Anyway, onto the PMIs. As I read through the other reports on the S&P Global site, I noticed they decided to lead with weaker increase in starting salaries amid further sharp rise in candidate availability. Not ideal, chat, and you'd think this sets the tone for future private sector employment numbers. And as discussed last week, public sector jobs are offsetting some of this, but a larger transition from public to private sector on this front, or private to public, depending on which way around you're talking about it, job vacancies, unemployment, employment, etc., will cause a drag on productivity because public sector jobs are not as productive as private sector jobs. And aside from anything else, that is damaging for sustainable growth in an economy. Flash PMIs told a different story, though, for August. Fabulous news overall. The composite printing 53, which is smack on healthy growth or sustainable growth or 2% GDP growth pace. Services at 53.6, manufacturing 47.3. So those services numbers and the composite numbers are 12-month highs. And for the past couple of months, the numbers have been revised quite a long way upwards as well. I'm not sure that'll be the case this month, but we can always hope. But the strapline, strongest rise in UK private sector business activity since August 2024. New business volumes expanded at the strongest pace since October 2024. I get the feeling from reading this that the business community has come to a similar conclusion to myself, and led by all the chat in the news, of course. Business tax isn't taking the pain in this October of this budget. The people are, whether that's going to be savings, inheritance tax, property, more on that in the deep dive, or whatever it is. Income tax, if they grew a pair and got rid of their stupid manifesto promise that they've already broken anyway last year. I wonder if they've got the gumption to put income tax up. I guess it will have to depend on just how much they've got to find, but you can guarantee they'll be freezing the thresholds for income tax as far out as they can. The text does note that employment total workforce numbers decreased for the 11th month in a row, and at a marked pace, which takes some of the edge off the good news. Input cost inflation was also its highest since May. Employers' NI hike still being cited, of course. But if September's PMIs look like this, it will be welcome news. GDP figures might not follow immediately, especially because we have this noise in Q1 being influenced by external factors like tariffs. But I'd rather we had an underlying 53 print in the PMIs and not worry too much about the GDP quarterly figures, which are always subject to tons of revisions anyway, just as we saw last week. And there was another one this week about just before the pandemic, if you missed it in the headlines. That was going back, years ago. So the take from the chief business economist at S&P Global, well, accelerated growth after a sluggish spring, manufacturing stabilising, but the demand environment is uneven and fragile. Goods exporting falling especially sharply. Payroll numbers continue to be cut at an aggressive rate, and most importantly, for the first time I can remember for over a year, he did not call for a further rate cut. Instead, he recognised that with inflation high, and this report looking a little better, that future rate cuts are going to be very data dependent. We have to take good news away from this little lot. Next up, the private rents and house prices from the ONS and the monthly numbers from the OBR. Just to clarify the usual confusion, the figures of rents are for July, the figures for house prices are for June. But the rent increase growth rate, that headline number, down to 5.9 over the past 12 months, with the last print at 6.7. Scotland behind the pack, as it still adjusts to the removal of rent controls, with a rise of only 3.6% over the last 12 months. Who would have thought removing rent controls would actually help the market? How strange. June's house price print is 3.7% up on the year, which is a large increase from the 2.7% print for May 2025. Now, this month we have seen an improvement in methodology, as they like to call it, so all bets might be off in terms of that 3.7, as there are larger than usual revisions in this month's release from February 2025 onwards. Let's get into it. Prices have had a very wobbly year as they really got noisy around the stamp holiday deadline of the 31st of March. The number so far in 2025 for year-on-year increase has varied from 2.5 to 7.7, which is a huge amount of COVID-style noise, actually, as it goes. But these improved methods of which they speak have revised some of that noise down a bit. And overall, they're showing a lower increase in house prices in the UK over that period from February onwards now. I remember them talking about another improved method last year that was more reflective of the types of houses changing hands. And it was basically cheaper houses transacting more and going for more money, basically, in the face of interest rate normalization. So this is what tends to happen. People don't necessarily have to sell in a distressed way. But if that, we saw some figures in the southeast that some house prices were down 4%. Well, if you're down 4% and it costs you, 7-8% to move because you've got big stamp duty bills and things like that, then what happens is people tend to sit on things until they've recovered all of that. They don't necessarily crystallize those losses, but people in cheaper houses are still trading up. It's a very broad simplicity. Of course, houses of all prices still sell across the country, but it's certainly been the case that the market's been easier, and certainly it's always more volume in lower price brackets, but it's been even more than usual. But this estimate, this change in measurements, this improved method, is about new builds and previous overestimates of sale prices and costs, we're told, but that's all we get told. So what do we know? We have to take these things at face value normally. When we look at the regional figures, as I always do in this report, the Northeast laid waste to all other regions, printing 7.8% up year on year, 700 basis points ahead of London at 0.8 year on year. And as usual, we go from north to the Midlands to the south as those figures decline, with the England average at 3.3. And this has very much been the case since the interest rate normalisation. It's just hitting people harder and stretched affordability more down in the southeast than it does in the north and the Midlands as a general rule. Northeast also wins the rent inflation chart with an even higher print of 8.9. So yields are just about still increasing there, as they are all around the country, just about. If you see 3.7 on house prices, but 5.9 on rents, you know that yields are generally increasing. Usually, where's London in the rent chart? It's normally a bit higher up. It's back in the pack this month at 6.3 versus the England average of 6%. And the laggard remains Yorkshire and the Humber. I still remain suspicious about why this is. Is there just a large amount of housing in Yorkshire and the Humber, and there's not a particular shortage? The ONS have never really tried to explain this over the recent year or so that Yorkshire and the Humber have been lagging. And the other three regions below the average are the West Midlands, and then the Southeast and the Southwest. However, yields are increasing in every single region as rent growth still outstrips capital growth, according to the ONS. This is often quite a similar story month to month, although some of the regions are moving around. There's been an element of convergence between the house price increase and the rent increase, because the former has been all over the place this year, as I've already said. The latter has been falling, but it's been coming back from that high of 9%, which is congruent with what we said in the inflation figures about OOH. This OOH measure at 5.5 for July is very close to the rent figure of 5.9, and the difference would be the other housing costs, basically, not just limited to rent or proxy mortgage figures or whatever. However, I'd like to say one more thing. The outperformance of the North, and to an extent the Midlands, is not sustainable in the long run, nor will it persist, in my view, when mortgage lending becomes A, cheaper, and B, comparatively easier to come by, as it already is, with affordability and stress tests loosened somewhat in the regulatory guidelines. Now, the bigger forecasters don't agree with me and just think the North and the Midlands will outstrip the rest over the next 5 years. I don't really see a reason why the South, and particularly the Southeast and London, won't catch up on what's now been a basically laggardly period of capital growth over the past 5, or in the case of London, 10 years. But we have to see how they do as a region. Almost always when you look at regional growth figures, regional PMIs, things like that, I don't normally talk about them on here too much because you're getting down right into the detail, but I do look at them. And what you normally see is London is a big driver of economic growth, outperforming all the other regions. And then you see various different areas doing better or worse on a monthly basis. Okay, so what about this OBR monthly report? Well, I'm going to have to call it out here because this was woefully underreported this week, and I'm definitely seeing some selective bias going on in the reporting. Now, you could say, look, that's always the case with political parties. You could say it's symptomatic of the fact the press leans more right than it leans left. You could say you don't get clicks for saying we actually hit our targets or did a bit better this month. People only want to read what reinforces what they're already being told or what they want to believe. That's not how it works with me, and in the supplement, it's not the way that I do things. You could say the media are biased against Rachel Reeves because she's the first female chancellor. I can't tell you which of all of those statements are true, and it isn't pick one because, of course, several of them can be true at the same time. The truth is often a mixture of all the factors, although the misogyny claim is more directed about the sort of commentary Rachel Reeves attracts, rather than failing to report on when she doesn't fail, and reveling in reporting when she does, of course. But it does feel like the deck is a long way stacked against Rachel Reeves. Now, you could take the alternative view. She's brought it on herself, not misogyny, to be clear, but performance or reporting bias. Hurting the private sector in the face of helping the public sector would probably be a more balanced view, and very typical Labour ideology, even the centre-right side of the party that are actually at the very top in charge, although the rest of the MPs aren't necessarily on that bus, like many of them were or forced onto that bus under Blair. But anyway, I said last week, worked out okay in terms of growth figures. It's working out poorly in terms of unemployment, although things are going okay for inactivity, as I pointed out last week. And it's worked out poorly in terms of inflation. There's not really any other argument any other way there. I don't think many people are going around not saying a fair amount of this inflation is due to the changes in national insurance. The currency's doing okay, although 2025 is the year of the weak dollar, so it's more a case of avoiding errors. The debt policy, fiscal policy, I don't think it's pro-growth, and government spending will only do so much. But I'm willing to raise my overall assessment on Rachel Reeves at this point to about 5.5 out of 10. I don't like some of the stuff that she's done. Indeed, it's actively hurt me. But arguably, I've done well because other people panicked before the last budget. So actually, it might well be a wash by the end of the 5 years if she's going to serve a full term, which many people think she isn't. Of course, I've spoken about that before. I'm less than convinced on their argument as well at the moment, to be honest. I don't think hurting the private sector is a good long-term solution, but it's probably not the long-term plan. It's just a short-term stopgap, he says, hopefully. Could do better would be a classic school report here. I heard a podcast the other day with Maurice Glassman. Have you not heard of him? The founder of the Blue Labour movement, an academic, interesting chap. Doesn't sound very particularly Labour, apart from in flashes when he very much does when he speaks. And he suggested that actually it was probably the case that Reeves was doing an okay job, and it was pretty much Reeves and Starmer. It wasn't dissimilar to Margaret Thatcher's first 12 months. Didn't look like they knew what they were doing, struggling with communication, struggling to get to grips with things, was what he said, which was an interesting parallel to draw. And of course, Thatcher went on to do, depending on your viewpoint, at least significant things, let's say. Right. So what was the headline that wasn't a headline? Well, The Guardian published it, but they were the only ones that I saw that did. Well, the monthly commentary on the public sector finances measures how much we've borrowed versus the OBR forecast of borrowing, which is the only one that really matters when it comes to fiscal policy. Many more are used for monetary policy, of course, but the OBR is so very influential that this is the big one for the government. To very little fanfare, we borrowed less than expected in the economic consensus, but had moved from 3 months a year borrowing exactly what was forecast to 4 months in and borrowing a little bit less than 100 million more than expected. And that sounds very blasé, of course, but this is a rounding error at this level. I mean, if anyone ever wants to make a rounding error like that in my bank account, of course, I'll gladly accept it and keep quiet. But the net debt, 96.1% of GDP, just so we're clear, not ideal, but not moving upwards horrifically quickly. The news versus the forecast, nowhere near as these 50 billion plus black hole claims that some people have been saying. The last couple of weeks has wiped out an awful lot of that, actually, to be honest. Inflation much higher than predicted for September, defining the government increases in many benefits payments, as I've already discussed, will hurt, and also hurt on the cost of debt when it comes to index-linked bonds. But I don't see a problem anywhere near as high as the commentators have been suggesting. More growth than expected is phenomenally helpful too. Don't forget, when the economy grows, the government takes in about 38% of all that growth in tax receipts. That's the rough number that we work to over the years. What about our guilty pleasures then? The 5-year, well, a quiet week, opened at 4.061, closed at 4.094. The top was 4.171 on Friday morning, but there was a fast decay to close back under 4.1. The swaps, well, on Thursday, the 5-year gilts closed at 4.13, and the swaps closed at 3.776 in unison. 35.4 basis points below, preserving the discount we've talked about for over 12 months now. 1 month ago, 3.663. 1 year ago, 3.683. So if you notice, the 5-year mortgage rates don't look a lot lower. This is why we're about 0.1 ahead of where we've been loosely as a bit of an average over the past 12 months. So I usually add 2% onto that as a bit of a ready reckoner, and that would see you at about 5.7, 5.8 for a limited company mortgage, 5-year fixed, no fee. How much did the longs go up then, we ask ourselves? Well, on Monday, we had our highest close since 1998 on the 30s, over 5.6%, which I just can't tell you how much of a whopping big number that is for a gilt. Not much of a haircut since then, really, to close at 5.547. Now, the week opened at 5.542, so half a basis point change over the course of the week. But the yield curve got a little bit shallower over the week. I'd rather that it wasn't getting shallower by the 5-year going up, but that's what happened. Nothing to write home about, though, but we can still see support, and there are buyers for bonds above 5.6%, it would seem. Why the drift? Well, inflation mainly, but Monday was not inflation day. It may well have been more of a continuation of last week's activity, plus internationally, most of the developed markets gilts saw highs as well. Not all economies have exactly the same problems, but there is a variant of the population and demographic situation. Too many non-workers, not enough workers, particularly age-based in the population pyramids, in much of the larger economies in Europe. But nothing to get too sad about. This week's deep dive selected itself, as I said, because what else could I do other than address the multiple lines of attack that seem to leak, read test the water, from the Treasury this week about changing tax on property. The heart skipped a beat when the initial assessment was tax reform on stamp duty. Yay, it's a terrible tax that discourages transactions. I have multiple transactions each month that I don't get involved with that I otherwise would because of stamp duty. And I can't be the only one. This is what transaction taxes do, ultimately. Fewer transactions at a higher cost. But replace it with what? Well, I ran a LinkedIn poll offering a few options. The narrow winner was a US property tax style system, which was to an extent proposed this week as one of the solutions. Don't pay up front, but pay monthly. Confusing to those of us who pay monthly, which of course is every household unless you have an exemption, because surely this is just council tax in any other form, is it not? Well, no, and in the States, this is easier to explain because it's accepted that taxes are collected at the state level and the federal level. We just don't really seem to look at it too much like that around here. And also, council tax doesn't just go to the local authority, in case you didn't already know that. More complex than that. There's money going to and from local government to central government all the time for different things. But it would have to be more. I mean, if you're going to get rid of stamp duty, you're talking about 15 billion quid per year in lost revenue if you take away that transaction tax. So how does the US system actually look? Because it's often lauded as this great solution. Well, it depends where you live. If it's Illinois or New Jersey, the effective tax rate is 2% or more of the property's value year on year. So your average-ish £300,000 UK home, that council tax would be about $6,000 a year at its most aggressive. In its most generous states, remember that's only on the average home, right? Such as Alabama or Colorado, it's about 0.5% a year. So 1,500 quid a year, which is probably cheaper than our council tax system as a general rule in a lot of the country. It also varies at the council level. So there is an element of similarity there. Some states reassess the values every year. Some of them, like California, put a 2% cap on the increase, which distorts mobility, of course, because older residents who don't necessarily have massive incomes anymore, but might pay more tax per year if they're downsized, especially if they've been a house for 30 plus years. But this is what transaction taxes do. They reduce mobility, as I said. But what do we learn from tax experts and what economists think about the US system? Well, like stamp duty, but different, it can lower the amount of transactions there would otherwise be because of the way it plays out from state to state. It also changes mobility between states. And if you listen to the anecdotal evidence out there, but also watch the population figures, tax status is causing significant state migration in the US, from California to Texas, for example. Now, it's the reason for that migration that's the key, not necessarily for forcing it all on the fact that the tax regime in California is too high and it's much more generous in Texas. But we know that people change behavior when they consider what they're going to do based on tax thresholds and brackets and things like that. Lower property taxes sometimes translate into higher values. However, unless you're a strict libertarian, you do accept that taxes have to be raised somewhere, and so the system is the system. Public services have to be paid for somehow. The argument for more tax on property and land is that unlike the rich, for example, and that's what's said, what really is meant there is the really quite super rich, you can't tax and raise billions because there's a small number of them and many of them are already worldwide mobile. But land has a fixed supply. Common sense economics, really. However, all tax changes make people change their behaviour, and this is widely known by HMRC, the OBR, the government, and every other relevant public body, the Treasury, etc., etc. So what we have is a system that looks similar to the US already, plus large transaction taxes. However, and I never see this discussion had properly, so I wanted to try and do it here. Everybody talks about this without bringing the cost of other frictional costs into play. I've listened to a couple of now, probably the number one tax expert in the country, I would suggest, Dan Needle, been on a couple of podcasts, including The Rest is Money, probably the most high-profile economics podcast, doesn't mention a thing about the other costs that there are in other countries, comparables, things like that, sticks to comparables of the UK and why stamp duty is a bad tax. And it is a bad tax based on things like tax fairness and things like that, don't get me wrong, but why are we not looking at what the rest of the G7 are doing, etc., etc. You might be loosely aware of an ongoing discussion that's been there for many years about the hollowing out of the UK estate agent and the race to the bottom, sort of thing Chris Watkin talks about all the time. Race to the bottom in estate agency, fees below 1% on selling houses. You know, we moan about paying 1% to the agent on a sale plus VAT, but our legals are really not very expensive for conveyancing when you consider the cost of professional services in this day and age, right? The stamp duty is huge, and it's got huger twice in the past 12 months. But that's the biggie. You need to throw in moving costs too, but we can probably assume they're largely equivalent across comparable nations. But with this in mind, I looked at the cost of moving in the G7 nations for a comparison. What usually washes out is that where the money goes, that really causes the issue rather than the actual percentage. Now, a round trip transaction in the USA is the cost of that, as they call it over there, is between 6.5% and 9% in costs, where about 5 or 6% of the value of the property is being paid by the vendor to a realtor. So it's going to a private business rather than to the state. Then there'd be some business taxes on profits and blah, blah, blah. Then transfer taxes of up to 2% paid by the vendor as well. So a small amount of a stamp duty style system in some states exists, right? In the UK, we still come out cheaper. You have to forget investment property for the moment and what we trade in, the extra 5%. Now, of course, you can't forget it if you're buying second homes and homes in limited companies and the likes. But we come out of 3 to 4% overall in cheaper areas, but more like 8% to 13% in London based on average prices. So you have to add 5% onto each of those for investment transactions. So 8 to 9 on cheaper stuff, so it becomes 13 to 18, doesn't it, in London, which is another reason why it becomes so very difficult to buy investment property in London unless you're getting a really, really, really good deal. I tend to find it comes in at about 7% on most of the investment transactions we do, 7 to 7.5%, but we're tending to buy below the sort of 150 grand level. Or we're buying companies where the stamp duty regime is completely different, of course. Canada, well, between 5 and 9% in total, but in Toronto it looks more like London. And by that, to be clear, I mean not London, Ontario, but London, England. Toronto has buyer-side land transaction tax between 4 and 7%. So 8 to 12 is what specifically it looks like in Toronto. Germany, 12 to 16% in total. Commission paid on both sides to the agents, notaries, brokers getting about 6 to 7% of that. France is notoriously expensive on the buyer's side, although not quite as bad as Germany, actually, as it goes. 11 to 15% on resale, with very expensive brokers taking between 4 and 7% of the transaction. New builds are cheaper to transact on as it goes, which is sort of the case in England as well, really, if you project the first-time buyer discount onto new build property, which is sometimes the case, but obviously not always. Italy, well, another country with a second home additional duty. Notaries, buying agents, quite a lot of other countries have a buyer's agent as well as a seller's agent, pumping up the costs. 9% additional duty on second homes. Be careful what you wish for, folks. Frictional costs are being between 7 and 10% on first homes and 12 to 15 on second homes in Italy. And then Japan looks a bit more like London again. Frictional costs about 9 to 13%, double agents, acquisition taxes, and the likes. Now, I think this is worthwhile because nobody talks about this. Nobody tried to make this case this week. And perhaps it's because those who are talking about tax having a bit of an agenda to keep tax down or have some ideological points of view that stamp duty is a bad tax, which it is, right? But I'm not complaining about any of that. I'm just stating a fact, right? We would normally look at comparable countries and analyse based on that. So as the primary reasoning here actually seems to be cui bono, as the lawyers would say, as they say in Latin, which is who benefits, right? And for us, it's mostly the government, not the private sector, who survive on wafer-thin conditions and sausage machine conveyancing in the UK system. Our 3 to 4% for cheaper housing is by far the cheapest in the G7. So all we have to compare things to is when our transaction taxes were far, far, far lower, and back then there were far, far more transactions. It will never be untrue to say transaction taxes lower the number of transactions that take place, but the equivalence you'd need to draw would be that it is more damaging to the economy to stop people from moving. Then you can get into some analysis which very few people do. What's the actual cash requirement to move house, right? If as a first-time buyer, you can borrow at 95% or even more loan to value, but in London, stamp might look like 3% of that transaction anyway. Well, the stamp is 60% of the size of the deposit, or it makes the deposit 1.6 times bigger that you need if you look at it in an alternative way. Now, this is a blocker which could be worked upon. You could pay your stamp over 5 years, for example, to grease the transaction wheels. That could be first-time buyers only. This is if you really cared about getting people onto the property ladder and is not relevant to investors, unless in a huge volte-face you actually wanted to encourage them rather than spending the last decade doing your best to try and discourage them. It won't be happening in this government, I don't think, and we all know the focus is on raising revenue rather than actually helping people most of the time anyway. That cost for a London first-time buyer has gone up by £7,500 in almost every case since the end of the Liz Truss SDLT holiday from 2022. No small beer when considering your very first house move. The alternative is to encourage and support people taking 5-year personal loans to pay the stamp. But why not cut out the middleman and allow HMRC to offer the plan at a lower rate of interest, but with a restriction on the title or a second charge or some element of government guarantee, effectively. So what about the leaks from this week and the probability of them happening? Well, first up, tax on homes sold for more than 500k. There was a paper being discussed in Podcastistan this week, and one kind regular reader shared the original paper with me too, from Tim Lunig, which is called Onward, a Fairer Property Tax. So it comes from the centre-right leaning think tank Onward, and he makes some good points in the paper. I've just summarised it rather than get into any more detail. Council tax is regressive. Poorer people pay more. I'm sure you've heard the old 3-bed semi in Blackpool or Bolton pays the same as Buckingham Palace. Stamp duty is a terrible tax. Neither of the two taxes meet any of the criteria for a good tax. Make it proportional, a percentage of the value of the actual property. His idea, local government taxes property up to 500 grand, central government after that. But let's remember the annual tax on enveloped dwellings, which I didn't hear anybody else mention, already exists, right? A tax on any property that's not let out, but is owned in a limited company and worth over 500 grand. If you have assets within your limited companies that are individually worth over 500k, you should make sure that your accountant or you yourself are filing ATED returns even when there's zero returns, just as a reminder. And in order to be fair, you have to stop stamp duty and then wait for the new revenues to come in on these homes above 500k. So you wouldn't levy stamp duty anymore, but you'd levy the new tax on the way in on transactions over 500,000. Sounds like it's creating a new black hole to me, Tim, to be honest. Not a revenue raiser. Lunig didn't propose it as a revenue raiser. He's just trying to make it fair. This new system raises about the same amount of money as the old system. Now, I don't see it taking off because of the cash gap side of things. While we wait for the revenues, it feels a little bit politically unsustainable at this time. Stamp raises about 15 billion a year, as I said. And why would you stop the 5% additional for second home buyers? It's not stopped the investment market, although, as I said earlier on, it makes more transactions unviable than it did before when it was 3%. Other countries are levying it. Scotland is at 8% already and still has an active investment market. Certainly now rent controls have been addressed anyway. The mentality of the 21st century, you think, would rather pay more monthly than pay up front, although those near the end of their careers may well have to think twice. Also, a whole bunch of people who are lucky enough to live in houses above 500k don't pay the tax because they've already paid stamp duty. So then they don't move because they don't want to pick up a new bill at £10,000 a year if 2% is roughly where it would be pitched. If it was pitched at 1% and you move to £1 million house, it's still another £10,000 a year you're going to have to think about in terms of running costs that's going out in tax. And most people would value £10,000 a year extra going out in tax at about £20,000 realistically per year in terms of the way they think about it. That'd also be quite rational because if you're paying income tax at nearly the 50% level, or you're paying double taxation through corporation tax and then dividends, you are paying tax at the 50% level. So another £10,000 a year is another £20,000 of income that you'd have to consider walking out the door. Now, Onward have another model which came to light on Tuesday. 0.54% property sales tax on homes between 500,000 and $1 million, 0.81 on homes over $1 million, payable on the sale of a primary residence. Well, be a cracking vote loser, crushing middle-class aspirations, I would think. And even considering touching the exemption on private homes for CGT is a tough one to touch, especially when inheritance tax lurks in the background anyway. The FT wasted no time in driving a truck through that one. Now, there were suggestions that ditching stamp would mean another 70,000 transactions each year, although it's clear it would really depend on what replaced it. It would also be very regionally distortionary, of course, with 59% of London homes being over 500k versus 8% of homes in the northeast. Now, some would argue, well, that's not such a bad thing, levelling up, etc., etc. That's according to the Rightmove data. Anyway, feels a bit tricky, though. The tax cap is the problem, unless people were given the option. This is the government we're talking about. What did get a fair amount of airtime last summer or before the October 2024 budget was council tax reform. Now, this is one that will age the audience. Where were you for the poll tax rights in 1990? Some listening were probably safely in mum's tummy or not even a twinkle in their parents' eyes. But I was 11 and I remember the news and the reaction right up there with Britain crashing out of the ERM. The memories are etched in there 35 years later. I'm the same age as Rachel Reeves and I'd expect similarly economically interested. So I dare say she might feel the same. And that political fear of even touching council tax has been there ever since. The system is widely critiqued and has been for a long time. No revaluation since 1991. Antiquated, outrageously unjust and manifestly absurd, Andrew Rawlsley said this week. Split the top band or bring some new bands into play to catch the highest value properties. I expected this at last year's budget, and it fits in the bracket of taxing the wealthy, which has widespread political support. On the stuff that doesn't move, property, which makes sense. Across the political spectrum, you saw the press this week describing how the frozen 1991 bans distort equity and funding. Backlash in terms of riots seems unlikely from Kensington and Chelsea, for example, or the leafier parts of Solihull. We won't like it, but we'll take it. We then heard rural communities will take it particularly hard over the coming 3 years, and that 5% annually might become the norm for this Parliament on council tax rises. It's exactly where my inflation expectations on council tax were anyway, if I'm honest with you. So that part still strikes me as likely. But where someone like Loonig calls for rebalancing and putting council tax down in bands A to C, I just don't see it. Tax just does not work like that. The taxes that raise the real money, income tax, VAT, are ultimately paid by every full-time worker and plenty of part-time workers and every consumer, everyone. Although I suppose there's probably some lunatic out there who bases their diet around what's VAT free, I'm sure. It's hard to buy pan to cook it in, but perhaps they've imported an air fryer from somewhere and not paid the VAT on it. Who knows? Tax works when everybody pays it. Instead, perhaps freeze or be kinder to bands A to C, but put the rest up more and put council tax up more in higher value areas to make it more proportional. So what did Dan Needle of Tax Policy Associates propose for the banding changes? Well, he said split band H into H1 to H4. H1 is the current band H. H2 is 2 million plus houses, 50% more expensive than H1. H3 is 4 million plus houses, 100% more expensive than H1. And then £8 million plus houses being 200% more expensive than H1. Would it raise money? Sure, but it's more political than anything. The alternative, a percentage levy, a property tax of, say, 0.5% above 2 million, rising to 0.7 above 4 million and 1.1 above 8 million. £10,000 per year on houses at £2 million as a bill. Well, that would probably force quite a few transactions of older people in larger houses or nicely located flats in London, I dare say. I can already visualise the Telegraph headlines. Dan sort of shrugs his shoulders and says, well, be a one-off hit to the value of those properties. You're already rich, tough luck, there you go, is kind of how he talks about it. But how much are we talking about here? Well, it raised back £250 million. So the sort of thing the political would see as the Chancellor would raise political capital from, really, rather than meaningful capital. Percentage overlays raise more like £1.5 billion a year, but my goodness, I think that would devalue some higher end property. An £8 million house pays an extra £7,333 per month out of taxed income. So again, if they're income taxpayers, you're talking about 15 grand a month extra that you've got to find in a year. Now, if you can afford an £8 million house, perhaps you could just say, well, that's no big deal, really. But there we go. And we're not talking about, there aren't tons of £8 million houses anyway. I'll talk about that in a moment. But it's not a small amount of money, 15 grand a month. And lots of property owned 40 plus years would simply have to be sold with an element of urgency if that happens. But there's definitely a one-off capital hit to homes above 2 million if you go down this route, directly hurting their wealth. I know that not many people will cry for them, and I get it. Tax justice campaigners and Gary Stevenson will be delighted. Though having seen his flat in his podcast, I'm pretty sure that comes in over 2 million and he'll pay it with a smile on his face, I'm sure. But let's be clear, At 8 million plus, you're talking about a few thousand homes. So it is this political exercise. And the 1.5 billion that would be raised will come, the bulk of it anyway, from that bracket between 2 million and 4 million, because that's the way that tax always works. Doesn't matter because you live in a £500,000 house. Well, sure, but bands expand and the system gets hungrier year on year. They don't go up with inflation, these things. They'll come downwards to raise more because they're politically very popular. And then it'd be houses over 1 million. And then it'd be houses over 500,000. And then it'd be houses over 300 grand. And that is just how it works, right? Tax has got form over hundreds and hundreds of years of doing that. Income tax was only on the rich when it was first introduced in the 1600s. Never forget that, right? So council tax reform then of sorts, but with no one actually better off apart from the public purse. Well, that's what I think is going to have to come out of this situation. Looks like a wealth tax, so it ticks that box, keeps a few of the lefties happy, those who don't necessarily look at the numbers that taxes raise or don't, but think more about the tax justice side of things, justice being their particular ideological bent on the whole thing, of course. 1.5 billion raised, it'd be good, it'd win some political points. What other reforms might we see? Well, updated valuations, which effectively an extension tax, if you like. Well, that'll take about 10 years to implement, costs about 400 million quid. Wales spends 18 million per 5 years on revaluations now. And England has got 20 times the population of Wales. Or use an AVM and an AI to supplement it, maybe. After all, that's what the government promised. Sensible use of AI. Perhaps I should stop giving them ideas now. But anyway, whatever direction, as Yaz said in this week's quote, the only way is up when it comes to tax at this moment under this regime. But before I close, don't forget to book your super early bird tickets to the next property business workshop that Rod and I are running on Wednesday, the 1st of October in central London. This time around, investment metrics and how to run your property business at scale, my favourite topic of all. Book at bit.ly/PBWEIGHT, link in the show notes. And above all, please remember to keep calm, always listen to the supplement and carry on. There will be opportunities abound this year and towards 2030 and beyond. The landscape has been set for a surefire bull run in house prices. It will be slowish, take a little bit of time to get things off the ground, and the amount of stock around is still keeping things suppressed at the moment. But as yields currently continue to improve, it's a case of here we go for the investment market, in my opinion. Thanks everyone for watching.